Whether the market is climbing or dipping, it's normal to feel a bit anxious about your investments, or even wonder how financial shifts, like inflation, might impact your day-to-day life. But here's the good news: it's going to be okay. In moments of uncertainty, it's important not to let fear take the wheel. As Warren Buffett wisely said, "Bad news is an investor's best friend." With the right mindset and strategies, you can not only survive challenging market conditions, but also thrive. Welcome to Financial Roadmap, where your journey to wealth begins. So in this video, I'm sharing 12 strategies for thriving when stocks drop. Remember, this is not financial advice, but solid strategies based on years of market observation. Let's get into it. Strategy number 1, don't let emotions take the wheel. When the stock market is on a roller coaster, it's only natural to panic. But when you let fear take over, you're more likely to make decisions that harm your investments. It's like going grocery shopping when you're starving. You end up making impulsive choices that you regret later. Take a step back. When the market is volatile, the best thing you can do is remove your emotions from the equation. Focus on the long term and avoid panic selling based on fear. You don't want to follow the herd into bad decisions. Strategy number 2, capitalize on the gig economy. Sometimes it's about having extra cash on hand. The gig economy can provide an additional income stream, especially when the markets are shaky. Whether it's driving for a rideshare app, doing freelance work in fields like graphic design, writing, or software development, having a side hustle can cushion the blow of any financial hardships. In fact, projections show that freelancers will outnumber traditional payroll employees by 2028 in the US. By getting involved in the gig economy, you can maintain a steady cash flow and ensure you have flexibility during uncertain times. Strategy number 3, ride the market roller coaster. You don't need to jump ship every time the stock market has a dip. In fact, one of the most effective strategies is to simply ride it out. Buckle up and hold on to your investments for the long term. Instead of trying to predict when to buy or sell, consider using a technique called dollar cost averaging. By regularly investing a fixed amount of money, regardless of stock price fluctuations, you reduce the impact of market volatility. Remember, time in the market is better than trying to time the market. Strategy number 4, protect your career during uncertainty. One of the biggest concerns during economic downturns is job security. Now is the time to make yourself indispensable at your company. Upskill, take on new projects, and showcase your value to your team. But also, be strategic. If you sense your current company is struggling, it might be time to look for opportunities at more resilient companies. Some companies thrive during downturns, and they might even be willing to pay top dollar to bring in the best talent. Make sure you find a company with strong financials and a track record of stability. Strategy number 5, block out the noise. News outlets and online commentary can create unnecessary panic. If you watch too much market news, you might feel pressured to make rash decisions. But guess what? Markets fluctuate all the time, and reacting to every dip or spike can hurt your portfolio in the long run. It's critical to stay informed, but there's a difference between being informed and being overwhelmed by market noise. Stick to your strategy and avoid making emotional decisions based on the latest headlines. Strategy number 6, keep some cash in reserve. When the market is down, it's tempting to buy every stock that seems like a good deal. But before you do, make sure you have an adequate emergency fund. Having around 15 to 20% of your portfolio in cash gives you flexibility without putting too much at risk. This cash reserve acts as a buffer against any immediate financial pressure you might face, and it ensures you have enough liquidity to seize opportunities when the time is right. Strategy number 7, seize the opportunity, buy when stocks are on sale. Now, when stock prices drop, some see it as a disaster, while others view it as a sale. It's true, buying during a dip can set you up for great returns later. Historically, bear markets are followed by significant gains. A Wells Fargo study found that the average 13-month return after a bear market is 43%. So, if you can afford to hold on to stocks for a while, buying when prices are low can help you score great profits when the market recovers. Strategy number 8, be strategic if you decide to sell. If you do feel the need to sell, make sure it's part of a well-thought-out plan, not a knee-jerk reaction to market turbulence. Consider trimming underperforming stocks. This frees up cash that you can use to invest in better opportunities or to pad your emergency fund. This isn't about panic selling, it's about rebalancing your portfolio strategically and preparing for future growth. Strategy number 9, don't keep all your eggs in one basket, diversify. Market downturns are a great reminder of the importance of diversification. By spreading your investments across different asset classes, industries, and geographies, you reduce the risk of any single investment dragging down your entire portfolio. Diversification protects you from being overly exposed to one particular stock or sector, which is especially important in volatile markets. Strategy number 10. Focus on long-term goals. Whenever the market takes a dive, it's easy to lose sight of your long-term financial goals. But here's the thing. Successful investors think long-term. Market dips are temporary. If you're investing for retirement or other long-term goals, those short-term fluctuations are just bumps in the road. Stay focused on your goals, and don't let short-term market events derail your strategy. Strategy number 11. Keep learning and upskilling. The market may be down, but that doesn't mean you should just sit still. Take this time to learn more about investing or to acquire new skills that can boost your earning potential. Whether it's learning more about financial markets or picking up new professional skills, staying sharp during a downturn can pay dividends in the future. Strategy number 12. Know when to take a break. Sometimes the best thing you can do during a market downturn is nothing. If you've done your homework and have a solid financial plan, there's no need to overreact. Take a step back, breathe, and avoid making impulsive decisions. Remember, downturns are a normal part of the economic cycle. By sticking to your strategy and taking care of your mental health, you'll be in a much better position to thrive when the market bounces back. Thanks for tuning in to Financial Roadmap. Make sure to subscribe and hit the notification bell so you don't miss any of our upcoming videos. We've got lots more content lined up to help you on your journey to financial freedom. Until next time, stay smart, stay calm, and stay invested. Take care.